Good afternoon, and welcome to this webinar on charitable giving sponsored by the Endowment Committee of the Unitarian Universalist Fellowship of San Miguel de Allende. My name is Gary Belkin, and I serve as the treasurer of our fellowship. As our UU family has grown, so has the breadth of our services and activities, as well as the amount of our annual donations that contribute to the betterment of the local Mexican community. Looking forward to future needs, the Endowment Committee was formed to enhance and support the fellowship's long-term mission beyond which the annual operating budget may address. The Endowment Committee is sponsoring this two-part webinar to provide you with an awareness of ways in which you may help support that mission through the use of tax-efficient donations of cash and/or property. Our discussion will cover strategies most often utilized for charitable giving. The goal is to better enable you to choose those techniques that are most appropriate for you and provide information on how to implement your plan. Charitable giving is comprised of two components: annual donations and longer-term planned giving, or legacy giving, through which you can help support causes and organizations that you believe in. The strategies we will discuss apply to contributions to our endowment fund, as well as contributions to support our annual programs and contributions to other qualified charitable and religious organizations. This webinar is especially timely because September will be estate planning month in San Miguel, when people are encouraged to execute or update their estate plans. During September, San Miguel lawyers provide estate planning services at heavily discounted rates. I encourage you to make an appointment well in advance if you wish to take advantage of these reduced rates. And please keep in mind that it is up to you to consult with your individual advisors, your lawyers, accountants, and financial advisors to determine which of these methods may be best for you. Neither the fellowship nor the speakers can provide you with legal or tax advice. However, UUFSMA can work with you and your advisors to see that your charitable giving goals for our fellowship can be achieved. Today, I am going to discuss charitable giving techniques for U.S. citizens. By way of background, prior to retiring and moving to San Miguel full-time, I practiced law in Chicago, focusing on corporate, real estate planning, and tax issues. I was also a certified public accountant. Following my discussion today, June Oliver is going to discuss charitable giving opportunities for Canadian citizens. June is a CPA, and after many years climbing the corporate ladder, she founded the Tax Management Center in Oakville, Ontario, Canada in 1999. In 2014, she transitioned the business to her key employee, and it is a prospering business to this day. June has been the treasurer of Amistad Canada for over 10 years. She is a Rotarian and serves on the board of the EEE School for the Deaf in San Miguel. She and her husband are snowbirds, spending 6 months a year at their home in San Miguel and 6 months at their home lakeside, 2 hours north of Toronto. Next week, on July 21st, also at 1 p.m., Ian Clement, who practices law here in San Miguel, will discuss donations of Mexican property. Following the completion of our two-part webinar, it will be available for viewing on the UUFSMA YouTube channel. During our presentations today, if you have any questions, please type them into the chat box, which you will find at the bottom of your screen, and June and I will address them following our presentations. Alternatively, you can ask questions directly at that time. Now let's begin. I am going to discuss the following commonly used methods for charitable giving. First, with respect to gifts taking effect upon death. Number 1, a bequest in a will or trust. Number 2, naming UUFSMA as beneficiary of a retirement account. And number 3, naming UUFSMA as the beneficiary of your life insurance policy. Secondly, I will be discussing the 5 following methods for lifetime gifts. Number 1, cash, the method that we all know and use most frequently. Number 2, direct distributions from individual retirement accounts, IRAs. Number 3, donations of certain appreciated property. Fourth, donor-advised funds. And finally, 5th, charitable remainder trusts. Although this program was not designed to be a general estate planning program, I think it would be helpful to start with some estate planning considerations, including relevant income and estate tax principles, which are the foundation for charitable giving. First, it is important to have a properly executed estate plan to be sure that your wishes are followed. Laws are very specific as to what constitutes a valid and enforceable document, including rules relating to content, signature, and witness requirements. Laws vary from state to state and are entirely different here in Mexico. Simply adapting a form that you find on the internet or elsewhere may or may not work. Therefore, I recommend that you consult a qualified estate planning attorney. Separate documents may be advisable for the United States and for Mexico. If your U.S. estate plan references your Mexican property, it should be consistent with your Mexican will. Without an estate plan, state statutes contain rules to determine 1, who will receive your assets upon your death, 2, the percentage that each would receive, and 3, who may administer your estate. These may or may not be the people who you would choose. In addition, without a will, a court proceeding would be required to make these determinations. Court proceedings may be lengthy and costly, more costly than the cost of executing a valid will. Your estate plan should include a will and possibly a trust, as well as powers of attorney to allow somebody you choose to direct both your finances and your medical care in the event you become incapacitated. Your financial and medical power agents may be different people. Your estate plan, once adopted, should be reviewed periodically to determine whether any amendments would be advisable due to changes in probate laws, tax rates, family circumstances, or your finances. And remember that if you become incapacitated, you may lack the level of competency required to execute or amend your estate plan. Contributions to our fellowship and other qualified religious and charitable organizations may be deductible for both income and estate tax purposes. 2017 amendments to the United States Internal Revenue Code affected both income and estate taxes. Because some of those changes are effective only for years 2018 through 2025, without further amendment, tax rules and rates will revert to pre-2018 rules and rates on January 1st, 2026. Now let's take a look at the U.S. estate tax. Estates of United States citizens and residents are subject to United States estate tax, or death tax, as is commonly referred to. It is imposed on the amount by which the net value of the estate exceeds the exemption. Due to the exemption, very few states are subject to estate tax. The net value of the estate is the fair market value of all the decedent's worldwide assets, including cash, investments, real estate, life insurance, annuities, artwork, etc., etc. On the date of death, reduced by charitable bequests, bequests to a surviving spouse, debts, and estate administration expenses. For 2021 decedents, the exemption is a whopping $11,700,000. The exemption is adjusted annually for inflation. The 2017 legislation doubled the exemption. Unless the law is amended, the estate tax exemption will be cut in half in 2026. Federal estate tax ranges from 18% to 40%. In addition to the federal estate tax, 12 states and Washington, D.C. impose an estate tax. Please keep in mind that the exemption amount may be different in some of those states. For example, in Illinois, where I practiced law, the estate tax exemption is $4 million and is not indexed for inflation. More important to most people is the federal income tax. United States citizens and residents are subject to U.S. income tax on their worldwide income. You can elect each year to either itemize your deductions or take a standard deduction. Charitable deductions can be deducted for those who itemize their deductions. State income tax depends upon the state of primary residence or income from business activities in a state. The 2017 legislation almost doubled the standard deduction, limited the amount of deduction for state and local taxes, and eliminated personal exemptions. Therefore, many more people now elect the standard deduction. The standard deduction for calendar year 2021 is $14,250 for single people who are 65 or older. For a married couple, both 65 or older, filing a joint return, the standard deduction is $27,800. These rules will revert to pre-2018 rules in 2026 unless new legislation is enacted. The standard deduction will be decreased. Itemized deductions for state and local taxes will no longer be limited to $10,000, and personal exemptions will be reinstated. Hence, more people will then likely itemize their deductions. With that background, now let's look at the methods for charitable giving, starting with charitable donations that take effect upon death. First, you can provide for charitable bequests to UUFSMA in your will or trust. The bequest may be for a dollar amount, a percentage of your estate, or specific property, such as real estate, artwork, collections, etc. And the bequest can specify whether the bequest is to be allocated to the endowment fund, a purpose you specify, or for general purposes. Your U.S. estate plan should name Unitarian Universalist Fellowship of San Miguel de Allende, Texas, which is the name of our U.S. qualified charitable organization, as the recipient of your UUFSMA bequest. For those subject to U.S. estate tax, the taxable estate will be reduced by the fair market value of the charitable bequest at the time of death. The endowment fund is aware that some people intend to leave their San Miguel investments, home, artwork, collections, and furnishings to UUFSMA Endowment Fund. Next week, Ian Clement will discuss how to leave Mexican assets to UUFSMA. Secondly, naming UUFSMA as the beneficiary or perhaps the contingent beneficiary of your IRA or other qualified retirement plan can be an effective tax planning strategy, especially when deciding which assets to leave to charities and which to leave to loved ones. If you name an individual other than your spouse as beneficiary of your IRA or other qualified retirement plan, its value will be included in your taxable estate for estate tax purposes. In addition, distributions to your beneficiary from your IRA or other qualified retirement plan will be subject to income tax. Thus, especially for those whose estates are subject to estate tax, the total amount of tax payable with respect to your IRA can be very large if your designated beneficiary is an individual who is not your surviving spouse. With the potential federal estate tax, 40%, combined with the income tax for a beneficiary in, say, the 35% tax bracket, 75% of your retirement account would be paid to the IRS, leaving only 25% to the non-spouse beneficiary. The rules covering the distribution period for non-spouse beneficiaries changed substantially in 2020. Prior to that time, a great long-term tax planning vehicle was to name a young beneficiary, such as a grandchild, who could then take distributions over his or her life expectancy, thus allowing the earnings to grow tax deferred for a long period of time. Now, upon death, a non-spouse beneficiary must take all distributions from the IRA within 10 years following your death. If you name UUFSMA as the beneficiary, the IRA or other qualified retirement plan will be excluded from your estate for estate tax purposes. In addition, because UUFSMA is a tax-exempt organization, UUFSMA can liquidate the IRA or qualified retirement plan and it will not be subject to income tax. Thus, 100% of the value of your retirement plan will be available to UUFSMA. You can then leave other assets to your individual beneficiaries that will not subject them to the payment of income tax. And third, you can name UUFSMA as the beneficiary of a life insurance policy. As we age, the need for life insurance may diminish, yet many people still maintain life insurance policies with relatively small premiums or have policies that are fully paid. If you want to protect your spouse in the event of your prior death, you can designate UUFSMA as the contingent beneficiary. And remember that when you name UUFSMA as a beneficiary, the proceeds are not included in your taxable estate. Now let's focus on lifetime gifts. A planned program of lifetime charitable donations may entitle you to an income tax deduction and may lower your estate taxes by removing the asset and its appreciation from your estate. The 5 methods of charitable giving that I will outline are utilized by many of our members. Please note that the tax rules I will discuss are general rules that are subject to exceptions, and the application and tax savings depend upon your individual income tax level. First, cash donations, which we are most familiar with. Making a cash contribution is the simplest method of charitable giving. For those who itemize their tax deductions, the amount of the cash contribution is deductible as an itemized deduction. Your deduction for cash contributions to public charities is normally limited to 60% of your adjusted gross income. As part of the recent COVID recovery legislation for 2021, that deduction is limited to 100% of your adjusted gross income. If you exceed these limitations, they may be carried over to future years. However, even for those who do not itemize their deductions, each person may deduct up to $300 for contributions made in 2021, or $600 for a married couple. This is also a temporary provision and will not be available after this year. Secondly, and perhaps most importantly for many of our members, for seniors with individual retirement accounts, taxable distributions, known as required minimum distributions or RMDs, must be taken each year beginning with the year you turn age 72. Prior to 2020, RMDs were required to begin upon attaining age 70 and a half. The RMD for each year is calculated as a percentage of your IRA balance as of December 31st of the prior year, based upon life expectancy tables published by the IRS. And please note that the IRS recently revised those tables effective January 1st, 2022, in recognition of the fact that people are living longer. I think it had been about 20 years since those tables were last revised. If you take a distribution from your IRA and then use the money to make a charitable donation, the distribution will be taxable and the donation will be deductible for federal income tax purposes only if you itemize your deductions. However, if you make a charitable donation directly from your IRA to UUFSMA, which is termed a qualified charitable deduction, the donation will be considered a required minimum distribution and it will be excluded from your taxable income. Thus, the donation will effectively be deductible even if you do not itemize your deductions. The check from your IRA custodian must be payable directly to UUFSMA. There is a $100,000 limitation on how much of your RMD may qualify as a qualified charitable deduction each year. And please remember that this technique is only available for IRA distributions and not for distributions from other retirement plans. This is really a very effective tax planning strategy for many of our members. In addition, people with higher adjusted gross incomes pay higher medical premiums and more of their Social Security benefits are subject to income tax. Because adjusted gross income does not include qualified charitable deductions, by using qualified charitable deductions for your charitable giving, you may reduce the amount of your Social Security benefits that are taxable, and you may reduce your medical premiums. Once again, another very big benefit for some people who utilize qualified charitable deductions for their charitable giving. The third technique is the donation of certain appreciated property. Instead of donating cash, you may achieve more tax savings by donating certain assets that have appreciated in value. For those assets that qualify as long-term capital gain property, such as stocks, bonds, and real estate that you have held for over 1 year, you do not have to pay the capital gain tax that would be incurred if you sold the property and then donated the proceeds to UUFSMA. In addition, you can deduct the fair market value of the asset as an itemized charitable deduction if you itemize your deductions. In general, your itemized deduction for contributions of appreciated capital gain property is limited to 30% of your adjusted gross income. Any excess above that limitation may be carried forward for up to 5 years. Because UUFSMA is a tax-exempt organization, the property you contribute to UUFSMA may then be sold without incurring any tax on the gain, and 100% of the proceeds of the sale would then be available to UUFSMA. For example, if you sold stock worth $50,000 for which you had paid $10,000, the taxable gain would be $40,000. The capital gain tax at 20% would be $8,000. If you contribute the after-tax proceeds of $42,000, you would be entitled to a charitable deduction of $42,000, and our fellowship would receive $42,000. And that amount would be less if you are a high income taxpayer subject to the 3.8% income tax on net investment income, and or you are subject to state income tax. If instead you donated the stock, you would be entitled to a $50,000 charitable deduction, and UUFSMA would receive $50,000. Fourth is a donor-advised fund. If you make an irrevocable commitment to donating to charity beyond the current year, you can establish an investment account with a donor-advised fund to which you donate cash and or appreciated assets. The funds cannot be used for any purpose other than grant making to charities. The donor-advised fund account must be established and maintained with a qualified sponsoring organization. Most sponsoring organizations are qualified charities established by financial service firms such as Schwab, Fidelity, or Vanguard. There are also a number of other sponsoring organizations. Your contribution will be deductible as an itemized charitable deduction if you itemize your deductions, just as other deductions made directly to UUFSMA, even if the funds are not going to be dispersed to our fellowship or other qualified religious or charitable organizations that year. However, please note that you cannot make a qualified charitable deduction from your IRA to a donor-advised fund. You may invest your account amongst investment options offered by the donor-advised fund for tax-free growth. You may then recommend grants from the account to virtually any IRS-qualified public charity whenever you want. You may also name a successor to yourself to manage the account in the event of your incapacity or death. You may also designate a donor-advised fund as the beneficiary of your IRA or life insurance policy. And finally, fifth, charitable remainder trust. Establishing a charitable remainder trust is a great vehicle for 1, selling off highly appreciated assets without paying capital gains tax on the sale. 2, creating a steady stream of retirement income for life. And 3, leaving the remainder to our fellowship upon your death. Let's assume that you own real estate investment or stock in a company that is greatly appreciated in value, perhaps Apple, Microsoft, Amazon, Starbucks, etc. You now think it may be wise to sell that asset and diversify your investments to provide a more secure annual income stream. However, you would be subject to a hefty capital gain tax on the sale. If you establish a tax-exempt charitable remainder trust, you can contribute that property to the trust without incurring a capital gain tax. The trust would have 2 beneficiaries, you and the fellowship. Because the trust is tax-exempt, the trust can then sell the asset without incurring a capital gain tax and reinvest the proceeds in a more diversified portfolio. You, or somebody you name, would then receive a stream of income from the trust for a period of time you specify, not to exceed 20 years, or for your life. When you establish the charitable remainder trust, the actuarial value of the amount anticipated to be left to UUFSMA must be at least 10% of the amount contributed to the trust. When you establish the trust, you will be entitled to a charitable deduction based upon the amount that is estimated to be distributed to the fellowship when the trust expires. For example, if 20% of the amount of cash and fair market value of property contributed to the trust is estimated to be distributable to UUFSMA, your deduction will be the present value of that 20% amount. And because those assets have been removed from your estate, you will also lower the estate tax liability that might otherwise be incurred. The actual amount that the fellowship ultimately receives is, of course, dependent upon your longevity and the financial performance of the trust. A variation of a charitable remainder trust is a charitable lead trust. In a charitable lead trust, annual distributions are made to UUFSMA, and upon termination of the trust, the balance would be distributed to your designated beneficiaries. The tax rules regarding charitable lead trusts differ from those of charitable remainder trusts, but please be aware that it is another vehicle for planned giving. There are costs required to establish and maintain a charitable trust. Because of those costs, charitable remainder trusts are best utilized only when the amounts contributed to the trust are fairly substantial. In conclusion, circumstances and laws change, sometimes in very unexpected ways. I would like to end with a little vignette about how a decision to make a commitment to planned giving paid off for a tax-savvy philanthropic investor. In 2017, when the tax legislation was enacted, he knew that he would not be itemizing his deductions beginning in 2018. He recognized an opportunity to reap substantial income tax savings in 2017 by making an irrevocable future planned giving commitment. He established an account with the Donoradvised Fund in 2017 and funded it with substantially appreciated stock. The stock was then sold and the proceeds invested in the investments offered by the Donoradvised Fund. The stock he contributed was then worth $100,000. He had paid $5,000 for the stock. Thus, he had an unrealized gain of $95,000. He was not taxed on the $95,000 unrecognized gain, and he received a $100,000 charitable deduction in 2017. He was in the 33% federal income tax bracket in 2017. Therefore, he saved $33,000 in federal income tax. In 2018 and 2019, he satisfied his annual charitable giving by utilizing qualified charitable distributions from his IRA to partially satisfy his RMD requirements. In 2020, when the requirement to take RMDs was suspended for 1 year under the COVID recovery legislation, he satisfied his annual charitable giving by making grants from his donor-advised fund. In 2021, he is once again satisfying his annual charitable giving from his RMDs, and the remaining balance in his donor-advised fund continues to grow tax-free for future charitable grants. Of course, we don't know what the future will bring, but for this philanthropic investor, being tax-savvy paid off. Finally, I would once again like to remind you that this program is designed to provide you with an awareness of tax-efficient methods for making donations to UUFSMA and the Endowment Fund, but is not a substitute for seeking competent professional, legal, and financial advice to determine what planned giving strategies may be best for you. Although neither UUFSMA nor our speakers can provide you with individual advice, The fellowship remains available to work with you and your advisors to help you implement your plan giving objectives for our fellowship. I thank you very much for your attention. I hope this has been helpful. And now, June is going to tell us about charitable giving opportunities for Canadian citizens, after which we will be available to answer your questions.